Today, we're diving into a really fascinating story of transformation happening right now in India's agro-industrial sector. We're talking about Dalmia Bharat Sugar and its big pivot away from just being a traditional sugar company into something much more, a diversified bioenergy player. So the big question is, how are they pulling it off, and what could it mean for their future?
All right, so let's start with a puzzle. How can a company see its revenue fall by 17% while its profit actually grows by 17% in the very same quarter? It sounds kind of backward, right? Well, the answer lies in the strategic moat Dalmia has been building. It really rests on three key pillars. First, being incredibly efficient in their operations to keep costs tight. Second, building up a massive distillery scale to really capitalize on government mandates. And third, diversifying geographically to hedge against risks like a bad monsoon here in India.
So let's start at the beginning and look at how they actually built the foundation for this biorefinery model. This wasn't some overnight flip of a switch. It was a carefully planned, multi-year strategic investment. The period between fiscal years 2021 and 2023 was absolutely transformative. This is when the company essentially doubled its distillery capacity and also brought the Bagali sugar unit into its fold. This was the critical groundwork, you see, setting the stage for everything that was to come with their bioenergy strategy. And by fiscal 25, they really hit what you'd call critical mass. Their distillery volumes shot up to 9.17 crore liters in just the first half of the year alone. That brought their total capacity up to a whopping 950 kiloliters per day, or KLPD. Now, having that kind of scale is absolutely essential if you want to capitalize on the guaranteed demand coming from India's E20 blending mandate. That's the government's push to have our petrol contain 20% ethanol.
So, with that strong foundation in place, let's look at the bull case. How exactly is this big strategic pivot creating financial success and unlocking real value for the company?
In this slide, this is the aha moment. In February 2026, you can see their consolidated revenues were down 17%, mainly because government restrictions meant they sold 34% less sugar compared to the year before. And this is the key part. Look at the other side. Their EBITDA margins expanded by 400 basis points, and their bottom line, their profit, actually grew by 17% to 70 crore rupees. And the reason? Higher margin sales from their distillery. This is the biorefinery pivot in action, plain and simple.
On top of their own smart moves, a huge external catalyst popped up. In March of 26, geopolitical tensions way over in the Middle East caused Brent crude oil prices to spike to $116 a barrel. Now, this dramatically improves the economics of producing ethanol, making it even more profitable. And at the same time, the government gave them an additional export quota of over 87,000 tons, which meant an immediate boost to their cash flow.
Now, when we look at valuation, Dalmia is trading at a pretty big discount compared to its peers. Its price-to-earnings multiple is sitting around 8.56x, while other sector leaders like Balrampur are up closer to 22x. You combine that with a healthy interim dividend of 4 rupees 50 paise, and it suggests there could be a margin of safety for investors who are really focused on this energy transition story.
Of course, no story is complete without looking at the other side of the coin. So let's switch gears and really dig into the bear case and the key headwinds that the company has to navigate.
There are really three main risks to keep an eye on. First up, rising input costs, specifically the government-mandated prices for sugarcane. Second, there's a risk of oversupply, as a lot of companies in the region are all building up their ethanol capacity at the same time. And third, there's a potential working capital trap, which could come from a downward trend in how much sugar we consume domestically, plus a relatively high debt-to-equity ratio.
And here's a very real example of that input pressure. In Uttar Pradesh, the state advised price, or SAP, for sugarcane was hiked by 30 rupees per quintal. That directly squeezes the economics of production. This kind of regulatory risk is always there, and it's a core part of the bearish outlook.
Okay, so given those challenges, what's the outlook? What's the plan from management to de-risk the business and finally break free from those traditional, cyclical ups and downs of the sugar industry?
Well, the strategy for fiscal year 27 and beyond is pretty clear. It's all about aggressive capital allocation toward non-sugar revenues. The next big milestone we're watching is a 58 crore rupee, 13 tons per day, compressed biogas plant in Kolhapur. The fact that they just brought in a new CFO also seems to signal a much sharper focus on deploying capital strategically like this.
And to counter some of those domestic risks we talked about, the company has made a really interesting international move. In late 2025, they bought a 51% stake in a company called Eagle Agrotech over in Tanzania. The logic here is pretty straightforward. It's about decoupling their fortunes from the unpredictable Indian monsoon and any sudden shifts in domestic policy.
So at the end of the day, the goal here is to achieve insulation from those brutal commodity cycles. You've got the firm Government of India E20 mandate that guarantees someone will buy your ethanol. And then you have this integrated biorefinery model that's designed to shield the company from the kind of sugar arrears crises that have plagued the sector for decades. It's really a comprehensive strategy to build a more resilient and predictable business.
Which really leaves us with one final thought. With such a clear strategy to de-risk their old business and fully embrace this energy transition, the real question becomes, could Dalmia's biorefinery model actually become the new industry standard for everyone else to follow?